Okay, Chapter 6 is on inventory, so the next midterm is just Chapter 6 and 9, which is on property, plant, and equipment depreciation methods. So traditionally, that midterm has been better than the first two. So if you haven't been doing extremely well on the midterms or as well as you'd like, there's hope yet, because we've got these next two make up 200 of the 500 points, so you've got time to still recover in this class. So I'm going to introduce inventories today. Wednesday we'll finish up with them. We have class Wednesday, right? It's not fall break. Okay. We'll finish up on Wednesday with problems on the board, and then next week we'll do Monday introduction to property, plant, and equipment, and then the problems on Wednesday. So 2 weeks from today will be the third midterm. Okay? All right. Inventories. The objective is to control the inventory from damage or theft, and to report inventory in an accurate, realizable fashion on the financial statements, because it is part of current assets. Current assets are, once again, cash, what you're going to turn into cash, what you're going to sell, and so inventories are what you're going to sell. So for a merchandising or wholesaling company, you would just have merchandise inventory. So these are finished goods that you're going to be selling directly to your customers. A manufacturer will have three types of inventories. They will have raw material, whatever they buy from their suppliers that they use to construct their finished goods. They will have work in process. So at the balance sheet date, not everything on the manufacturing line is finished. So there will be some items that are partially finished, and that's work in process. And then finally, they'll have finished goods, which is what is ready to be shipped out to the customers. So safeguarding inventory, that's one of the two primary objectives in inventory controls, is to make sure that you record and track inventory the moment it is ordered and received. So the documents used for inventory control is a purchase order. So a lot of times these are automatically generated. Modern computer systems have order points based upon the time that it takes for the inventory customer, wherever you're buying your inventory from, to ship it to you. And so once it gets down to that threshold, you take the last item off the shelf, it automatically generates a purchase order, sends it to the approved vendors, and gets that. You have a receiving report. This is in the packaging of the item. It will not have a price on it. It will just have the item numbers, the description, and the quantity. And that's the same when you guys order something from Amazon. You get that. It's a packing list that is inside the box. It has that detail on there. And then lastly, directly to your accounts payable, you'll get a vendor invoice. So this is the three-way match that gives you the first layer of control over your inventory. The three-way match is: what did we order at what price? That's on the purchase order. What did we receive? That's the receiving report, because somebody in shipping and receiving is going to take that packing list and count all the boxes to make sure that we got everything that we ordered. And then what did we get charged? And that's going to show the item number, the quantity, the price that we are being charged, and that should match the purchase order. And then how much did we actually receive? And so if all three of those match, at that point, you can authorize payment to the vendor. So this is just the same thing. That purchase order authorizes the purchase. The receiving report establishes the quantity of the inventory that was received, and then all of this has to match up in order for the item to be approved. All right, so a subsidiary inventory ledger is just like similar to the subsidiary accounts receivable or accounts payable. This is just by part number. So even a small to medium-sized company could have hundreds and hundreds of parts. I've worked for aviation companies in the past that had thousands of parts. So the subsidiary accounting ledger will show it by part number, description, and the quantity. And then depending on whether or not you're using a periodic or perpetual inventory system, that quantity may or may not be up to date. So if it's a periodic, then the quantity that is in the subsidiary inventory ledger is only what we have available for sale for that period, because we haven't gone through and counted everything yet. So on a periodic system, you've got to do an end of period physical inventory to subtract out the items that are still left in ending inventory in order to determine what was sold. All right, and the flaw of that system is that we don't know whether it was damaged or it was stolen. We just know it's not on the shelf anymore. So that is one of the major reasons that even small companies have gone to a perpetual inventory system. And the advantage of a perpetual inventory system is that this subsidiary inventory ledger is up to date. Because every time we sell an item, it deducts it from inventory. Every time you go to H-E-B and you buy an item off the shelf, it updates the inventory records. So H-E-B at any point in time should be able to go into the records, into this subsidiary inventory ledger, and see how many loaves of bread that they have at the Evans and 281 Superstore. And then if you go and you count it, you do a cycle count, and it's short, there's your shrinkage. Because you can count at any point in time in the month. You don't have to wait for the end of the month. Anytime it's slow, you can send your parts employees out there to count a shelf. And that keeps the records up to date. And it also keeps control. Because one of the things I found, and I found this even outside of the aerospace business, is that 10% of your inventory will make up 90% of the value. There are going to be certain items that are very expensive. In the aerospace business, it's normally actuators, electric motors, and avionics equipment. All right, so altimeters and artificial horizons and the like. Those are very high dollar items. So you want to keep a very close eye on those. So every time they do a cycle count, they should count the expensive stuff. Make sure that it's still there so that you know immediately if one has disappeared. Because they can be tens, hundreds of thousands of dollars for some of this equipment. Okay? Security measures is inventory is always in locked areas that are restricted, authorized. Very, very high priced inventory may be in a separate item. We've always, in the past, when I've worked for aerospace, we've always had a avionics locker. So even inside the inventory area is a special locker that you keep the high dollar stuff in. All right? And then security tags, cameras, guards, and the like. So physical inventory is accounting. You still have to do a physical inventory even if you're using a perpetual inventory system. You need to do cycle counts in order to determine if there's any shrinkage, if there's an inventory that is missing. So you still have to do this periodically. You don't have to wait until year end. At year end, your auditors will probably come in for a couple of weeks of field work, and at that point, they're going to want to count certain items, do some test counts to see how accurate your inventory is. And so they'll go out there and observe your employees counting some high dollar items and then some other items just across the range of prices. Okay? All right, there are 3 inventory cost flow assumptions that we'll make in this course. FIFO, LIFO, and average cost. FIFO is first in, first out. All right? For years, when I first started teaching this course, used to use FIFO as the bread aisle. All right? Because what happens when they restock the bread? What do they do with the existing bread that's on the shelf? They pull it forward, right? They put the new bread in the back. That's FIFO, first in, first out. But what do we do when we go buy bread? Do we grab the bread that's in the front? No. You grab the bread that's in the back, because the bread that's in the back is the fresh bread. So now we're doing LIFO, last in, first out, because that was the bread that was delivered this morning. It's in the back. So that doesn't work anymore as a good example. The best example is the little corkscrew candy machines. You've all seen them. You put your dollar in, you press G7, and you get a bag of M&M peanuts. It's a little corkscrew. When the delivery guy comes, he opens up that whole machine and then stocks it in the back. So the new candy is in the back. You can't get to it. You're always buying the oldest piece of candy in the machine. It's unavoidable. You can't get to the back to get the new candy. All right? So that's FIFO. First in, first out. LIFO is last in, first out. So what's LIFO? Well, the bread that we talked about, that's LIFO. A big pyramid, they've got Dr. Pepper or Big Red on sale, and they build a big pyramid of 12 packs of cans. All right? Now, when you come in to buy, do you take the one on the bottom? You can't. The whole thing will fall down. You take the one on the top. And then when they rebuild the pyramid at the end of the day, do they lift up the cans that are there and put the new cans on the bottom? No, that would be absurd. They just put the cans on the top. So you're always grabbing the newest cans. The newest 12 packs are always at the top, and that's the one you're grabbing. Not until the pyramid is completely depleted do you get to the one on the bottom. All right? That's LIFO. Last in, first out. You're always buying and walking out of the store with the most recent delivery of 12 packs. All right? So do you see the difference between the two? FIFO and LIFO. So what's average cost? Average cost is a gas station. A gas station gets delivery of fuel, whether it's diesel or the 97 octane or the 87 octane. It goes into a big tank. And they just pour from the tanker truck into this big storage tank, and it gets all mixed up. So when you go buy 10 gallons of gas, you're getting a little bit from yesterday's delivery and a little bit from last week's delivery and maybe even a little bit of gas that's been in there for a year. It's all mixed up. That's average cost. Okay? So these are the 3 cost methods, and we'll go through some examples. So the scenario is very simple. We have 3 purchases of inventory, each where we bought 1 unit. We bought 1 unit on May 10th that cost us $9. We bought another unit on May 18th that cost us $13. And we finally bought one last unit on the 14th, on the 24th, that cost us $14. 3 units are available for sale. That's what we have. We have 3 units, total cost of $36. All right? So, if we're going to sell one unit at the end of the month, May 30th, for $20, which of those units did we sell? Did we sell the one that cost us $9 that we bought on May 10th? Did we sell the $13 one that we bought on the 18th? Or did we sell the $14 one? Or did we sell an average of $12, which is the average cost? And that's adding all three of them up. 9 plus 13 is 22, plus 14 is 36. 3 divided into 36 is $12 each. There's a fourth method that we're going to mention here, and then you will not hear me talk about it again. And that's specific identification. In some industries, items are so expensive that you know exactly what that particular item cost you. And a good example is jewelry stores. Diamonds that are sold now in the developing world are all serialized. They have microscopic serial numbers etched into the edge of the diamond. So that when you go buy one eventually for your wife, she's going to insist on it, right? You're going to insist on a diamond. I finally bought one 5 years into my marriage. I was very reluctant to get that darn thing, but finally broke down. Because it's all a scam, you realize that, right? Diamonds are not rare. They might as well be chalk. They're very, very common. The only reason it makes them expensive is they're controlled by a cartel called De Beers. And De Beers controls 90% of the diamonds mined and sold in the world. And they parcel them out. They keep them rare. It's all artificial. Anyway, it's the end of my diamond lecture. Not a big fan. So, they're etched. So the jeweler knows exactly what that particular diamond cost them, because they vary in value based upon clarity and cut and color and all this other stuff. All right? Same with automobiles. When you go buy a car from a car dealership, they know exactly what that car, depending upon the options and the model and the year and all that, they know exactly, based upon the VIN number, what the price of that particular car was. If you're an art gallery and you've got a Van Gogh or a Michelangelo or something like that hanging on your wall, you know exactly what that cost you. That's specific identification. Not going to test you on that, because what I'd have to do is tell you exactly what the prices are for the items that were sold. Too simple. FIFO, LIFO, and weighted average. These are the three cost flow methods that we'll be talking about. And it's worth mentioning here, the cost flow method that is elected by an entity, by a company, does not have to match the actual physical flow of the inventory through their process. And I'll give you an example. One of the companies, one of the industries that uses Lifo almost exclusively is the petroleum industry. They use it because they always want to match the cost of goods sold to the current price of oil. So they use Lifo. But physically, how does the oil come in? It's got to come in first out, first in, first out, because it's in a pipe. There's no way to get the latest shipment of oil to the other end of the pipe until you push all the rest of it through. So, but they use Lifo almost exclusively. Tesoro, Shell, BP, all of them use Lifo. All right? So here's the three cost methods that we'll be talking about. Back to our three examples. Under FIFO, which of the three units, these are the three units that we bought. Here's the May 10th at $9, the May 18th at $13, and the May 24th. So what do we have? Cost of goods sold under FIFO is the $9. So we sold it for $20. It cost us $9. We had a gross profit for the month of $11. What do we have in ending inventory? $27. We have the $13 unit and the $14 unit. So cost of goods sold is $9. Ending inventory is $27. What if it was Lifo? Well, under Lifo, the one that was sold is the last one. That's the last unit. So the cost of goods sold under that scenario is $14 for a gross profit of only $6. What's left in inventory? The May 10th $9 and the $13 from May 18th for $22. And then average cost, like I said, average cost is $12. That's the 9 plus the 13 plus the 14. That's $36. Divided by 3 is $12. That gives us a gross profit of $8. 2 units left in ending inventory times the $12. Ending inventory is $24. So you can see dramatically different answers depending upon the flow method that we elect. And this is an election. You decide when you first set up the accounting rules, the policies that you're going to select under US GAAP, you select that when you first set it up. So you can do anything you want. Right? Overwhelmingly, firms in the United States use FIFO. Internationally, it's even higher, because internationally does not allow Lifo. So Europe, Asia, Africa, South America, all of those that follow the international financial reporting standards does not allow Lifo. They allow average cost and they allow FIFO. That's it. So, but here in the United States, there's a significant, and this is primarily, almost exclusively petroleum, pharmaceutical. Those are the two that use Lifo for the majority of them. And then weighted average is everybody else. You can see there's not as many as that. Okay? So here's a new data. Under a perpetual inventory system, so we're gonna sell the unit. Every time we sell it, we're going to make an inventory adjustment. This is perpetual, continual throughout the month. So on this one, we have, at the beginning of the year, left over from last year, 1,000 units at $20 a piece. We sell 700 of them at $30 a piece on the 4th. Then we buy another 500. They cost us $22.40. Then we make 2 sales. We sell 360 on the 22nd of January. We sell 24 on the 28th of January. And then we end the month with buying 600 more units at $23.30. So under a perpetual inventory system, FIFO is going to be the first of the 3 examples that we're going to do. All right? And they give the example of milk and other perishable products stacked in front. But like I said, they stack them in the front, but we don't take them. We take the ones in the back. All right, so here is how we keep track under a perpetual. Because every time, so the first line item is the 1,000 units that we started with at $20 for $20,000 in cost. We then sell 700. Which 700 did we sell? Well, we only have one layer right now. We only have the $20 units. So the 700 were sold at $20 a piece. That's what it cost us. That's 14. What did that leave us? Well, if we sold 700 of the 1,000, we're left with 300 at $20, or our inventory after that January 4th sale is $6,000. we now buy another layer of $500, or 500 units. That cost us $22.40 for a total of $11,200. Add that here. Now we've got $17,200 in 800 units in total of goods available for sale. What did we sell? Well, we sold 360 units on the 22nd of January. So under FIFO, because now we got two types of units. We got the $20 units and we got the $22.40 units. So if we sell 360, which units did we sell? Under FIFO. So we're going to work our way down from the top of the inventory record down to the bottom. Well, we sold all 300 of these because we sold a total of 360. So we sold 300 at 20, that's 6,000, and the remaining 60 out of the total sale is the 2240 for a total of 1,344. What did that leave us with? Well, we have 440 out of the 500 that we bought back on the 10th because we sold 60 of this layer. So ending inventory consists of one layer, all at $22.40, for a total of $9,854. We did sell another 240. Only have one layer. So under FIFO, we're selling $22.40, the units that cost us $22.40, leaving us with 200. Then we buy the last purchase of the month, 600, and now ending inventory is 18,460, the total of those two. Okay? And then total cost of goods sold is the 14,000 plus the 6,000 plus the 1,344 plus the 5,376 for a total of 26,720. So that's FIFO. What about Lifo? Last in, first out. The original sale doesn't change because we only have $20 units to sell. What changes is here. Because when we make this 360 unit sale, all 360 units come from this batch of 500. Last in, first out. So that cost us $22.40, leaving us with the 300 that we had left over from the beginning inventory. And we now only have 140 left. So when we make that second sale of 240, we're going to sell off the remaining 140 of the 22 that cost us $22.40. And then we'll eat in by 100 units into this beginning inventory layer that cost us 20. So the difference between Lifo and FIFO is that back in FIFO, we had ending inventory of 18,460. Now we only have 17,980 because we have 200 units from the beginning inventory and then the 600 units that we bought on the second to last day of the month. Cost of goods sold under Lifo was $27,200. Back in FIFO, it was $26,720. So FIFO in a period of rising prices, prices are going up, then your cost of goods sold is always going to be lower under FIFO because you're selling the cheapest units first. Under Lifo, it will always be the highest. And then average cost, somewhere in the middle. So average cost. Once again, the January 4th still remains the same. So now we have two layers. We have the 300 layer and the 800 layer for a total cost of $23,200. So we have 1,100 units at a total cost of $23,200. Divide that, it gives you an average cost per unit of $21.50. I'm sorry. Yes. $21.50. Okay, no, they're doing the math for you here. We had 300, we bought another 500, that brought us to 800. This is the current total. 300 plus 500 is the 800. Average cost, because it was 6,000 plus 11,200 for a total of 17,200. 800 divided into the 17,200 is $21.50. So when we sell on the 20th, 2nd, and the 28th, it's at an average cost of $21.50, leaving us with 200 units at an average cost of $21.50. We buy another 600. Now we have 800 units at a total of $18,280. That's the $4,300 plus the $13,980. Divide the 800 into $18,280 and you get $22.85. And that's what you have at the end of the month. So it's in between. So average cost in a period of rising prices, average cost is going to be between FIFO and LIFO. The other thing that's worth mentioning here, because on Wednesday when I start doing examples on the board, I'll be doing a number of examples under a periodic as well as perpetual. And under a periodic, FIFO, first in, first out, is always going to give you the same answer. Because it doesn't matter if you make an entry every time you make a sale, or you wait until the end of the month and make one entry at the end of the month. If you're selling the oldest stuff first and working your way down, you're always going to have the newest inventory in ending inventory. Right? LIFO is going to be different because it's a timing thing. If you remember back to our LIFO here, it's all about timing as to which units we sell. Because when we sell this 360, we're selling the 500 that we just bought. If we waited all the way to the end of the month to take these entries out, we would have been selling this 600 first. So LIFO is always going to give you a different answer. So is weighted average versus average cost. The only one that's going to be the same, whether it's perpetual or periodic, is FIFO. Okay? All right. Periodic, they're just saying that you make an entry at the end of the accounting period. So let's go back to the same example. So this is now under a periodic. We have the January 1 inventory, the purchase on the 10th, and the purchase on the 30th. A total of 2,100 units available for sale. That's what we had in the entire month. Total cost of those 2,100 units is $45,180. We sell, we have at the end of the month 800 units. And that's the same as what we had before under the here, 800 units. All right? We've got the same 800 units. But only now we know the 800 came from the count that we did. All right? So under first in, first out, what 800 are they? It's the candy machine. It's the newest inventory. Sorry. It's the oldest inventory. So this is the most recent purchase on January 30th of 600 units under FIFO and 200 left from the January 10th. So total cost, total ending inventory is now 18,460. If I go back to the inventory, oops, going the wrong way. If I go back to the inventory here, 18,460. It's the same number under FIFO. Under Lifo, under Perpetual, it was 17,980. First out. And then you subtract that from the cost of available for sale. There's ending inventory, so that's what you sold. The total was 45,180. That was the entire pool of every unit that we could have sold. We still have 18,000 left on the shelf. So that means we sold 26. So that's how you do it under a periodic. So we bought these 3 units. That gave us the big pool. We still have this in ending inventory, the 600 and the 200, which means we sold the 1,000 and the 300. So that's our cost of goods sold. That's merchandise inventory. Under FIFO. Under Lifo, which 800 units are they? It's all the beginning inventory. All of the 800 units is at $20 because it's all from the 8,000 units that we started the month with. All right? So our cost of goods sold now is $29,180 and ending inventory is $16,000. So Lifo is always going to be the earliest units in the total pool. So now what we have in ending inventory is this. What did we sell? We sold 200 of these, all of these, and all of these. So this went to cost of goods sold. So that's Lifo. Average cost, divide the entire $45,180 cost of merchandise available for sale by the 2,100 units, you get a $21.51 average cost. Multiply that by the 800 units, ending inventory is 17,280. Subtract that from the goods total dollars cost of merchandise available for sale, and now our cost of merchandise sold is $27,972. So those are the 3 methods: FIFO, Lifo, and average cost. So who has a dishwasher at home? Everybody? What's your silverware drawer? Lifo or FIFO? How's that? What do you do with the spoons when you pull them out of the dishwasher? You put them on the top, right? Do you pick them up and put them on the bottom? No, you just put them on the top. So your silverware drawer is Lifo. I made that comment one time at lunch with a bunch of accounting professors, and one of the accounting professors who's now retired said, no, I FIFO my drawer. He picks up all the spoons and all the forks and he puts them on the bottom. He says, otherwise you're using the same spoons all over and over and over again. You're wearing them out. I said, come on. You can't wear out a spoon in a lifetime. You can't wear out a single spoon. So, yeah, but your silverware drawer is Lifo. Last in, first out. All right, I'll mention this for those of you that are going on in accounting. There is an exercise that has to be done at the end of the year. It's part of the audit. That is, your inventory has to be valued at the lower of cost or market. So in other words, if the prices of your inventory are going down in value, which happens a lot in the tech industry, because computer chips get cheaper and cheaper and cheaper. So if it's an inventory that is declining in value, this could come into play. And what it is you have to value the inventory on the balance sheet for what you could get for it, which is the estimated sale price less any cost of disposal. So if you're doing FOB shipping point, you have to deduct out the cost of freight. If you have to pack it up and put some sort of special packing around it, you have to deduct that. So the net realizable value is what you could sell it for, and that may come into play, especially if the cost is going down rather than up. It's in the current asset section almost exclusively. You always disclose in the footnotes what method you're using, FIFO, LIFO, or weighted, and then are you using the lower of cost or market or not. So this is how it's displayed. So you say merchandise inventory at lower of cost, first in, first out method. So that you disclose that on the balance sheet. That's it.
Hey, it worked this time.